Good morning. Today is Wednesday, May 20th, and this is another episode of the Market Commentators, a podcast brought to you by the Milwaukee Company. My name is Matt Salm. I'm an investment analyst at the firm, and joining me this morning is Andy Wilms, President and CEO of the Milwaukee Company, and Mike Wilms, who serves on our wealth management and portfolio strategy teams. Before we get into the details, I want to remind everyone that nothing on this podcast should be perceived or construed as investment advice. And with that, Andy and Mike, good morning.
Good morning, Matt.
Good morning, Andy.
Yeah.
All right. As usual, Andy, do you want to kick us off with a quick recap of some of the interesting moves in the market?
Well, it's certainly been interesting, the moves in the market the last few days. Last week, the market had a down week with NASDAQ and S&P falling NASDAQ down 1%, the S&P down 2%. The Dow finished the week last week down over 2.5% for its third negative week in 4, and its worst week since beginning of April. On Monday, the Dow forgot all about that, and the S&P. The market as a whole forgot all about that and went on a tear, with both the Dow and the S&P registering their biggest one-day gain since April 8th. And the principal driver of this is news from Moderna that supposedly was promising. I think you'll have a little bit more on that for us. And investors becoming increasingly bullish on the reopening plans, which we've all sort of not only heard about, but actually beginning to experience. I'm up here in Door County, Wisconsin, and they will be reopening their restaurants and whatnot on Friday. So, but I do know some of the restaurant owners up here, and they're being pretty careful about how they go about it. So I commend them on that. That's not been the case everywhere through Wisconsin, as the national news has pointed out. There's been some
and I had firsthand experience with that on Friday night up in the Minocqua area, and the bar owners, restaurant owners might be trying to practice the social distancing, but if the crowd ends up shoulder to shoulder, there's not much that you can do.
Yeah, and that's a big concern,
Right. I mean, people need to be vigilant and thoughtful, and some of that fell by the wayside because of the level of frustration.
Hopefully, it's just a short-term thing where people kind of get overly exuberant because they're happy to be finally free. It's like your day out of jail, and then ultimately you get back to being more responsible. That's what we have to hope for, because it only takes a handful of people to mess it up for everybody. Exactly. So, we got to all be conscious of that. And yesterday, then again, the market shifted directions, giving up almost half of Monday's gains. Because there was news that the potential corona vaccine wasn't, the questions were being raised about it. And so I guess this really points out in my mind that, the market's going to continue to swing rather wildly until there's really confirmed progress made on the medical front. And there's evidence that the state efforts to reopen their economies aren't going to lead to a significant spike in the coronavirus. As I pointed out in the past, I'm optimistic about the progress being made on treatments. Okay, but as Mike's comments point out, questions remain in my mind how quickly and safely the economy can be reopened. So that's why I think these announcements about treatments and vaccines are going to continue to drive the market for the short term, at least.
No question.
Talking a little bit more about Moderna, I can't speak too much to the medical side of things, right, just because I'm not trained in that area. But the data on their vaccine did initially look promising. Their stock actually jumped 30% on Monday, which I think tells you how much investors had faith in the vaccine potentially being useful. But it's still very far from being proven. This was a stage 1 clinical trial with, I believe, 45 participants. And they've got phase 2 trials lined up, and they're hoping to start phase 3, I think, by midsummer. So, as we get data from those further trials, we should learn a lot more. And I think the market will react accordingly.
And there have been several vaccine experts, to your point, Matt, that have said that the information released so far there's no way, based on that information, there's no way to determine the efficacy of this. And then yesterday, Mike, you probably saw some of this. There was a stock sale that the company did right after the announcement,
Right.
or issued more shares, I should say. And so people are questioning, how is that? The timing there doesn't look good, right? I mean, they pump and dump type of thing, this old expression.
Well, to bring to market an unannounced equity offering, I mean, that's the proverbial drive-by offering, and to sell $1.3 billion worth of new shares on unsubstantiated news, it's to Matt's point, I'm not a medical expert, but they did have 3 arms of the trial at different dosing levels. All of the 45 participants in the 315 patient arms developed antibodies, but nobody's even sure if the level of antibodies would prevent generating or developing the infection. So
and to Moderna's defense, so to speak, there has also been news stories that their hands was forced, because just like with the some of the other vaccines, there were news stories coming out about private conversations related to this testing that were going to be released. So they they were supposedly forced into releasing these test results ahead of time, and they had planned to do the stock sale before. And I mean, there's all different ways of looking at it. So anyway, I just thought I'd add
enough said.
Yeah, enough said.
Yeah. One other interesting, I guess, trending area related to the coronavirus, I think, is colleges reopening or planning to reopen, and some of the chaos in that space. My little sister's still in college, and my dad teaches at a local college, so we discuss this all the time around the dinner table. But I saw that Notre Dame is the first major university to say it would resume in-person classes starting in the fall. Which is, well, I guess, what do you guys think of that?
Well, first of all, you're impugning the university my son attends. I mean, I'd like to think the University of North Dakota is a major university also, but they announced 2 weeks ago that they would resume classes in the fall. So, and I got to tell you, I think that's a huge benefit to the students. The remote learning hasn't. At least my own personal impression is there's a drop in quality of education.
I have a son who's attending Marquette, and he hasn't. They haven't announced what they're going to do, but I don't think. If anything, this online education is showing that it's maybe not the panacea some people thought it was going to be. That eventually maybe online education would take over, and there wouldn't be need for college campuses. But young people need that a little bit of additional discipline of getting up, going to class, being accountable for their day, which is very hard to do when you're attending school online. So I agree with Mike, but I'm also very concerned about. I mean, just like people attending bars sometimes don't always behave properly after a few cocktails. I mean, you get a bunch of students together, and even though they're supposed to maintain social distancing and all of the things, it's hard. That's a lot to ask for an 18-year-old kid to do, and to really be that responsible. When we see that, fully grown adults, mature adults, tend to behave badly at times. So I had very mixed emotions about it.
Well, I would, the only quick comment I would make is there's a huge benefit to the social skills that students learn interacting with one another on campus.
I agree. In general, I agree. Yep.
Yeah, that's definitely interesting. Moving on then, Mike, do you want to share a bit about the bond market and some of the moves that have been happening there in the last week?
From the Treasury market's perspective, things have been very range bound, with the 10-year hovering between 60 and 70 basis points. Today will be the first day in decades that the U.S. Treasury issues 20-year bonds. This has been teed up. I think we've talked about this briefly, but the Treasury is starting to push out the average maturity of the debt that's outstanding to kind of control interest rates going into the future. Based on the Treasury rates and the ability to issue debt in this market, there was record non-financial bond sales in the month of April. $231 billion worth of new bonds were sold.
Corporate bonds, referring to, right, Mike? Non-financial corporate bonds. Okay.
Right, and thank you. And to this point, 148 billion in non-financial corporate bonds have been sold in May, so we're on track for it to be another record. And some of that is tied directly to the overall market has had a much stronger appetite for new issues, just simply because the Fed said that in the absence of traditional buyers, they would step in and buy either new issue or secondary corporate bonds. So from that perspective, some of the things that the Fed has implemented and has been trying to do are definitely helping the market and providing capital where it's needed in the economy.
Mike, I got a question for you. So you know, these corporate bonds basically have a willing mark on the other side, right? The government's saying we're going to buy it. So and I know you mentioned earlier, prior to the start of the podcast, you know, Apple and some of these other very secure companies issuing corporate bonds at very, very low rates. Do you think there might be some of this going on where these corporations saying, hey, listen, we know the government's going to buy it. We can stockpile cash for a future rainy day or whatever purpose we might want. Since we got a willing taker, why not sell even if we don't need the money right now? Which would be counterproductive, right? Because if they go ahead and just stick this money in the bank and, or don't put it to work, obviously, like, you know, that's not the intention of, that's not stimulating anything.
And you know, that's really an interesting question. And if you look at Apple as an example, at the end of the first quarter, they reported having $137 billion in cash. And I mean, that number is absolutely staggering.
I know, really.
And with the bonds that were issued here recently, they're approaching $100 billion in debt. So on a net basis, they could pay off all of their outstanding long-term debt. But the most recent bond, Costco sold 10-year bonds yesterday at 161 basis points, so materially below 2%. And, you know, if you're a well-performing company, if you sit down and do a CapEx analysis, if I can borrow for 161 basis points, and, you know, I would hope to earn a 10% or a double-digit return, 10% plus, borrowing and reinvesting in my business makes a hell of a lot of sense to me.
Yeah, and I would assume, and I guess this, I should know this, but I'm assuming that the government is being careful on what bonds it buys, right? It's probably not buying bonds from companies with huge cash balance sheets, but, big cash deposits on their balance sheets. But there's still a ripple effect, you know, and that kind of brings in the whole question about the effectiveness of the stimulus program. I don't know, Matt, if you've been paying attention to this, but, there's been a lot of questions raised about the way the U.S. government has gone about this as compared to what's going on in Europe and other countries where the government has actually, what we've done is given the money to the corporations, employers, saying, listen, take care of your employees, right? We leave it up to you. You've got the payroll set up, just do it. Well, and as we've seen, there's been some misdirection of those funds, right? I mean, and they haven't necessarily been being applied the way that they were intended. In Europe, the government's just saying, we'll pick up your payroll for you, and we'll actually pay the employees. And it seems to have been much more effective at maintaining lower unemployment rates. So there's a lot of questions being raised about the whole manner in which the U.S. is handling this stimulus. And these are, if they're mistakes, they're $1 trillion mistakes, right? Now we're talking about another $3 trillion stimulus because the first round may have been not handled as effectively as it should have. And that $1 trillion mistake is going to have a long-term impact on our country, I'm afraid. So we really got to be careful about how we go about this.
Yeah, I couldn't agree more that there's a need to be careful. And most of the things I've read have indicated that programs in other countries have been a bit more effective at keeping unemployment rates low. Granted, I'd say we're still in the middle of the crisis. And so we don't know who's going to come out looking better on the other side of this, 6 months, 12 months from now. But yeah, the need to be judicious with trillions of dollars is definitely very real. Like you said,
it's a little disheartening to think, and that if the government has made some really bad decisions on this early on, and I'm not trying to be critical in the sense that we were working under very tight time frames, and the need was to get the money out and didn't have maybe time to give it as much thought as they want. But it is worrisome that if these mistakes have been made and they've already irreversible mistakes, that it could have big problems for us going forward.
Yeah. Then were there any other aspects of the market you wanted to comment on, Mike? I don't know, anything in like oil or macroeconomic things as far as the contraction we're experiencing?
Well, I think everybody is aware of the fact that unemployment claims continue to go up. I mean, after last week's filings, 36.5 million people have filed for unemployment. We'll get new numbers tomorrow morning. It looks like the weekly filing rate is starting to slow down a little bit. And we had some key economic numbers come out as far as drop in retail sales and
minus 16%, I think, in retail in April.
16.4, and the manufacturing side of the economy contracted by 11.4%. So that kind of ties in with where you're seeing the jump in unemployment claims and slowdown in economic activity. And with a concern about economic activity and growth, that's why you're seeing such a large influence in new issuance in corporate bonds. So the slowdown in the economy kind of bleeds into what's going on in the corporate fixed income world.
Yeah, that makes sense that it would all be connected. Moving on then to the portfolio management section, where we try to bring everything back right to what individual investors would care about. Obviously, there's a lot of uncertainty. We've said that every single week, and I don't think that uncertainty has decreased very much over the past week. But with things being so unusual and in some cases extremely volatile, I was wondering, Andy, if you could elaborate a bit on what you think is going on or what's causing some of that extreme volatility.
Well, I think the volatility is being caused by the rather extreme differences of opinion on Wall Street as to how this is all going to play out. On the one hand, you have the investors who are thinking that the Fed has established a bottom in the market and by all the stimulus that we've talking about. And then on the other hand, you got those who say the market swift recovery sort of begs for a retesting of the March 23rd lows. And then, on one hand, you have the investors who say investors are far too negative, and others are pointing to some of the numbers Mike was referring to say, no, the market's far too optimistic. So, in the meantime, the whole situation with what's going to happen with the pandemic remains unpredictable, and the future is simply unknowable. So it all boils down to say that I think investors are collectively undecided on the path for stocks in the economy. There's not a lot of conviction amongst a big group of investors. So whatever the latest news that comes out, if you don't have a strong conviction one way or the other, you're going to swing with that news, and the markets are swinging as a result. I think there's a potential that if we found a medical solution and the economy opened up smoothly, there would be there may not, even if that were to happen, valuations have gotten so high right now that almost back to valuations that rivaled where we were at the start of 2019. there may not be much more room for upside, even if everything goes smoothly, right? So, but then on the other hand, if you just looked at it from a historical perspective and earnings per share ratio and things like valuation metrics such as that, the CAPE ratio, you'd say we don't have a whole lot of room to go higher. But then we've never had this much money pumped into the economy either. So you could say, well, yeah, but now that you got, we're talking maybe $10 trillion of stimulus, that could push stock prices much higher if everything goes smoothly. So I think that's what's causing all the back and forth.
Well, I think some of the Wall Street prognosticators are talking about the fact with interest rates as low, there's no other alternative but stocks, and that's leading to some of the move higher in equities. And the big difference in opinion really is the bond market is saying that the economy is not doing very well with the low interest rates, and yet the extent to which the equity markets have come back is really pretty amazing. Which is basically saying there's a confidence that this will be, the economy will be coming back sooner than what the bond market is predicting.
So it boils down to whether you're more concerned about return on your principal or return of your principal.
Exactly. Well said. So, and obviously uncertainty reigns.
And if it looks like you're gonna get your principal back, because there's a vaccine, market news is positive one day. Oh, let's buy in and worry about return on our principal. And then if some bad news comes out and maybe this economy is going to go bad, or we're going to have more and more trouble, then you get more focused on return of principal.
Exactly.
And so.
Did I teach you that?
I don't think so. The things that you taught me, we can't talk about on this podcast.
And then there's that.
Yeah. So uncertainty reigns supreme, as Mike said. But how does an individual investor deal with that, Andy?
Well, I have 4 fundamental thoughts that I would share with our viewers today, and how I would approach it as an individual investor, not institutional. But don't put money in the stock market right now. Don't add to your allocation equities if you think you might need that money in the next 5 years, because we just don't know. Second of all, even though we've talked about in the past, diversity hasn't been rewarded as of late. Maintain a diversified portfolio, and with the understanding that you're going to at least be partially wrong, right? But you'll be partially right too. I'd look at this as potentially a good opportunity to harvest tax losses. If you have any and you can take advantage of those, remember they carry forward indefinitely. And I've talked about in the past, and I keep harping on this because I think it's such a tremendous opportunity. If the value of your IRA has been dropped as a result of what's going on in the markets, it's a great time to consider converting part of a traditional IRA to a Roth IRA.
Yeah, I think that last one makes a lot of sense for investors who have a lot of money in their IRA, especially because tax rates by historical levels are quite low now as well. And with all of the stimulus, there's a chance that tax rates could go up in the future, regardless of who's in the White House, just because we have more debt to pay off.
Right. I think it's highly likely.
And I was going to just say, Matt, for younger investors such as yourself, Roth IRA, if you're going to make contributions, I would think very strongly about doing it to a Roth IRA rather than a traditional IRA, because of the ultimate tax benefits associated with the Roth IRA.
Yeah, that makes sense. And then another topic we've talked about before on the podcast is inflation. And I know with all of the discussion of potentially $3 trillion more in stimulus, inflation is still very much on a lot of people's minds. So I guess there's a considerable disagreement on whether or not we're heading towards a lot of inflation at the moment. But could you share a little bit more on that, Andy, for people who are concerned?
Well, again, it depends on your time frame, right? Because the unprecedented decline in demand, supply and demand determines price, right? We all know that. And so when demand drops, it's deflationary, and prices have really, demand has really dropped. So I don't think we're looking at inflation in in the immediate future. I don't think many people are concerned about that, but in the longer run, classic economic theory in which I was trained, would indicate that a dramatic increase in the quantity of money without a corresponding increase in GDP makes inflation unavoidable down the road. I mean, it's, more money chasing the same or less goods would raise price. But the market's clearly not worried about that, as Mike has pointed out. I mean, that may be due in part because everybody, myself, and not everybody, but many people, myself included, were worried about inflation after the 2008-2009 crisis with the extraordinary amount of stimulus that was pumped in then, and didn't lead to inflation at that time. And some people are thinking there's a new paradigm, that's this old classic economics is wrong. But I personally think Mr. Market is probably underestimating the long-term risk of inflation. But I wouldn't bet the farm on it. I wouldn't make big bets that you're going to have inflation, but I would look to hedge against that risk a little bit with a variety of investments that are less sensitive to inflation. As a part of my
gold is putting in a recent high. It's 1,700 and change, and that's normally an indication somebody is betting on inflation.
Mm-hmm. Yeah.
I'd say the other key variable in the classical economic model, though, is going to be velocity of money, right? And so if corporations are hoarding cash, I'm not saying they are, but if they do, and if people decide to build up their savings account because they've seen that jobs can disappear overnight when something like a pandemic hits, then it could also be possible, right, that quantity of money could increase dramatically. But we don't see inflation if consumer and company behavior just changes.
Well, that's an excellent point, actually, because the amount of cash in circulation is what really counts, right? Money sitting in a bank account isn't inflationary because it's not being used to buy goods. It's the money that's being spent, that's being chasing goods, that's determinative. But then again, if interest rates are near zero, nobody's going to want, not nobody, but it's hard to imagine corporations are going to want to sit on stockpiles of cash after the pandemic is over. And, they're going to want to put that money to work, right? That's why I'm saying in the long term that, even in consumers, right? I don't know if this is going to be enough to change consumer behavior where, the United States has a terrible history of savings rates in the last 20, 30 years. I mean, is this going to be enough to get people to really change their behavior permanently? Possibly, but I'm not so confident of that. I think people will whip out their wallets quicker than you think. And people will be spending the money that I've known a lot of people who've spent their stimulus check on $1,200 on something totally frivolous, rather than sticking it into savings. So I wouldn't, like I said, I wouldn't bet the farm on it, but I think taking a little bit of precaution on protecting yourself with a variety of inflation investments that do well in inflationary periods would be probably a good thing to consider.
Yeah, absolutely. And if anyone who's listening has any other questions they'd like to discuss, please send them over to us. firm@milwaukeecompany.com is probably the best way to reach us. Or if you have any of our individual emails, that works as well. And then if you enjoyed this podcast, consider subscribing to our newsletter, which comes out every single Friday. Andy usually writes a column for the newsletter. I have a new column on there, and a few other people at the firm have columns as well. So you'll get a variety of opinions on some trending topics of the day. And we're also a bit more active on Twitter now at the Milwaukee Co. So consider following us there. And one last thing, if you enjoy this podcast, would be to give it a like wherever you listen to it and subscribe as well, because that helps more people find the show. If you like, subscribe, leave a comment, anything like that. So thank you all for listening, and thank you, Andy and Mike, for joining this morning.
Thank you. And can I throw in one shameless plug? I'd like to mention we're going to be having a new website, and we hope to unveil it still this week and maybe push back to next week. But take a look. It's going to be at our same website address, www.milwaukeecompany.com. Take a look, and I think hopefully you'll enjoy it. All right, guys. Thank you very much. Have a great rest of the day, and pleasure spending time with you.
Thanks, guys.
Yep. Bye.
Bye-bye.
Bye-bye.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.